How much due diligence do you do on these companies that you're selling? If it's a first time seller, they decide to go with FE International. What are you doing from them? What are you looking for?
We do a lot. So essentially, what we put together is a quality of earnings like you would expect from a PwC or Deloitte if you hired them to audit your own business. So
does that cost? Is that included in the commission you make, or is that upfront?
Yeah. It is included. It depends on the transaction. Sometimes we'll have a retainer in there, depending on the state of their financials and the size of the business. So sometimes there is a retainer to cover that process. Sometimes it's part of the fee, and it really depends on the level of work. But it's generally from our side, and we track all of this obviously by the hour, hundreds of hours of work, more than 100 hours of work from accountants. And most of our team in our audit team come from PwC, KPMG, Deloitte. They come from big accounting firms, and they're used to doing quality of earnings reports. We will do that to make sure financials are legitimate and accurate. And a lot of sellers, even if they don't realize they get their numbers wrong, it's not necessarily malicious, but sometimes even their accountants can be wrong. So just having an accountant alone does not necessarily mean your numbers are going to be accurate. And one of the biggest reasons deals fall through, and this is why we've always refined it over the years, is financials not adding up. So many, many years ago, we got very strict with audit, and we do not negotiate with sellers on the level of due diligence we do up front. So it's generally a multi-week, hundreds of hours from multiple people in our team. We also do operational, technical, legal, and other due diligence to make sure, I guess, and this is not exactly what we're doing, but I want to be in a position where every business we represent, you could buy, not do any due diligence, and the business would be as it was represented. Obviously, my legal caveat is you should always do due diligence, but the spirit of what we're trying to achieve is a situation where nothing a seller has represented or we've included in our prospectus is factually incorrect. So if we say a business is making $5 million SDE, it's proven it makes $5 million SDE. You don't go through due diligence and find out it actually makes $2 million. That does not mean that you like every business we're representing, because sometimes people just don't like the business model, they don't like the industry, they don't like the seller, they don't like the strategy. But our job is not to make a judgment on what people like. Our job in due diligence is to make sure that the business is legitimate. And ultimately, that's how you build, at least my belief is that's how you build a firm that's been around for 13 years in the industry, whereas a lot of others go out of business in 2. We have a reputation for good deals. Buyers might feel like they have to overpay or pay a premium to win deals that we're representing. But ultimately, if you buy a legitimate business, you grow it and you sell it for 3 times what you paid in 5 years' time, to your point about momentum, you can be extremely successful, even if you had to overpay a little bit on the way in because you couldn't buy that business privately and persuade the seller that their business is worth 50% less, which is what a lot will try. But as the industry, to your point, has got more competitive, it's much harder. As a private buyer, it's much harder now to persuade sellers to sell because they all have access to huge amount of content that companies like us provide.
Let me ask you about that. Bring it back to the audit and the quality of earnings. Audit is verified in the books, and just make it a clarification. It's like quality of earnings actually makes a call on the future potential of the earnings. Do you actually do that?
We do, and again, it will depend. The extent we go into quality of earnings will depend on specifically the business, how long it's been around. But no, we do, because a business is only worth the value of its future cash flows. Obviously, all you have at time of sale is what it's been making in the past. But as a buyer, you have to have firm belief that business is going to continue into the future. So if there is, for example, you have a business making $10 million a year, but $10 million comes from one client, and that one client is on a rolling annual agreement, and it can't be transferred to a new buyer, that is significantly more risky than the same business with 100 clients paying, say, $100,000 a year. who will have 3-year agreements with automatic extensions, and those agreements could be reassigned. So yes, it definitely is something we look at, particularly at valuation stage as well, because if you look at those two businesses side by side, on paper they look very similar. They both make $10 million, but the business with 100 customers paying $100,000 a year with 3-year contracts and an assignment clause is going to be worth significantly more than the business with one client with no automatic extensions and no way to reassign that agreement. So yes, we do. And it's important because your existing financials being legitimate are one thing, but the future of the business is what really matters. You could lots of businesses made a lot of money over the last kind of couple of years during COVID, for example, and are now making nothing. So it is important you think about the longevity as well.
Where's that line? Because when you get smaller, and is it lower middle market, or is it just a small SMB? Where does it get important where that quality of earnings comes in?
I think it's important at every level. So, I mean, that's why we don't represent businesses which are worth $100,000, because quite honestly, it's not worth the physical expense of going through that process would not make sense. So I don't think that. I think at any level, whether you're buying a business or selling a business, I think it's essential. I mean, it would be different if we're talking about you have $1 billion and you're looking at a business that is valued at $1 million. Maybe at that level, you can afford to do less due diligence and you can kind of take more of an educated risk. But if, like most buyers, you're only ever going to buy 1 to 5 businesses lifetime or in your entire career, it doesn't matter if that business is $1 million or $100 million. You still need to establish quality of earnings and make sure it's stable and consistent and will grow in the future. Obviously, the amount of work that can go into that is varies, because the trouble, and this is part of the reason we do it in house. We've seen clients who have spent. I think I saw a transaction a couple of years ago. It was a $3 million deal. The buyer hired a Big Four accounting firm to do quality of earnings, and I think they spent $500,000, which is relative to the size of the deal is not, wouldn't call it crazy, is a good level of diligence, but that to me is overkill for something of that size. So there's
unless he saw an opportunity where he could turn that into a $50 million company in 2 to 3 years, right?
Very true. But I think what a lot of people, and going back to the earlier point about competitors in the industry, what a lot of people don't realize is that actual good advice and good talent that can do that quality of earnings is not cheap. So we provide it as cost effectively as you can, but you could also go hire one of those kind of M&A firms that will charge you, say, 3% for a $10 million deal, and then go pay for your own quality of earnings. And by the time you've done that, you could end up in a much worse position, and you're definitely out of pocket for the quality of earnings, and the business still might not be sellable. So that's why we offer everything in-house. We've always found that's the...
I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at DEALFLOWSYSTEM.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.